All right. All right. So I'm Jack Lowenstein. Everybody hear that? From Morphic Asset Management. And we're here to talk about the Morphic Global Opportunities Fund and the Morphic Ethical Equities Fund. I'm going to speak briefly about the Morphic Ethical Equities Fund and my thoughts about the discount, which is very frustrating for both you and ourselves, discount between the NTA and the share price. We have a guest speaker, Anna Young-Ferris from Sydney University, who's going to talk from a slightly more academic point of view about why ethical investing makes a difference. Then I'm going to talk about what exactly it is we do in the ethical investing category. I'm going to talk about our fund positioning, and then we're going to have time for questions. And when we have questions, I hope my colleagues Chad and Jeff will come forward to answer some of those as well. So, briefly, Morphic Ethical Equities Fund. We floated the shares at $1.10 just over a year ago. The NTA at that point was $1.07. We're happy to say the NTA today is about $1.16, but very frustratingly, the share price is, I think, $1.03, be it $1.05 offer, which is very, 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 very disappointing for us, and I'm sure very disappointing for many people in the room. What I can tell you is that we're doing our best to try and correct that through an increased marketing campaign. We've had great turnout for all our meetings around Australia. This is the last of a series of meetings. We had over 70 people turn up in Melbourne, for example, last week. The other thing I can tell you is we made a commitment to do our best to pay a dividend for the full year ending September 2018. We were happy to bring that forward by 6 months, so the shares are currently come a 1 cent fully franked dividend. And we only decided to bring that forward by 6 months because we had a high level of confidence we could maintain that level of dividend for at least another 3 or 4 periods. In other words, we're confident now we can pay a 1 cent fully franked dividend every half for at least the next 2 years. We'll only raise a dividend once we've got that kind of clarity about the outlook for the next 2 years, but our plan is to continue to raise the dividend steadily. In terms of the NTA, I wish I was Jeff Wilson, who many of you will know. Jeff Wilson now will be pounding the table saying, this is your opportunity to buy $1.16 for $1.03. Get on your phone, speak to your broker, but please wait till after the meeting. But in all seriousness, it is a very rare opportunity to do that, and we hope to take advantage of it because while it's frustrating for us, it also creates a new opportunity. Now I'm going to introduce Anna Scott-Ferris, who's going to speak briefly about the broader context of what ethical investing is.
Good afternoon, everyone. My name's actually Anna Young-Ferris.
Oh, sorry.
It's okay. And it's a pleasure to be here with you this afternoon. I'm going to talk to you a little bit about my research, which is, and my career going from corporate into academia, which is always focused on conscious business and ESG integration. But first up, I really just want to talk about what Morphic does in terms of Jack's used the term ethical investing. I think they're doing a lot more than sort of what I traditionally know as ethical investing in terms of environmental social governance, which is what the ESG stands for up there, integration. So, and that's really where I see a lot of the funds management industry making a huge difference, and particularly, being signatories to the Principles for Responsible Investment, the PRI. So please feel free to stop me if I say too many acronyms. I'll try to continue to spell them out in full. So firstly, I kind of want to just bring it back to a case that we're all probably very familiar with. It was over 8 years ago now, and that's the BP Deepwater Horizon incident. Okay, so on the 20th of April in 2010, there was a huge explosion on an offshore oil rig. And, this made oil spill into the Gulf of Mexico for almost 5 months, had devastating effects on the wildlife, the environment, and killed 11 people, sadly, injured 17. And obviously there was a massive hit to the share price. I've thankfully been informed that Morphic haven't or never have invested in BP. And there was also, a major impact on the oil and gas industry as a whole in terms of, taking the losses. And, the share price for BP hasn't ever fully recovered. I believe the compensation and the estimates kind of get changed around over the times in different reports, but somewhere in the order of 90 billion just in terms of cleanup costs for the company. And I believe the out-of-settlement sort of compensation claim or the fine that they've paid is around 20 billion. Why am I telling you all of this? Because investors that were sort of more on the ethical slant, or what I like to say, the responsible investors, actually were more astute when they're looking at a broader picture of a company and not just focusing on the financial impact and the financial performance of a company, but when they're actually looking at a broader picture and looking at the company's longer term prospects in terms of managing environmental and social impacts. So what the graph at the bottom shows us is BP in comparison to some of its peers and the different fines in terms of occupational health and safety and Environmental Protection Authority fines. And you can see in terms of millions of dollars, BP, far outweighed its competitors. So if you were an investor that was looking at the broader picture of a company, and which a lot of the investors, that are signed up to the Principles for Responsible Investment Initiative, they would have seen the warning signs at BP. And there was also the Texas incident in 2004. That was another explosion and, more fatalities, very unfortunately. So it's not about saying that we are favouring the environment or favouring people and not making money. It's about doing those two things together. And that's very much what I understand to be the Morphic philosophy. And so it's, and for the longer term, it is about looking after the people and the environment, because if we don't have, a planet, then there's no plan B, which I really love the marketing that Morphic have come up with this roadshow. So that's kind of a little bit of context so you understand that, as investors, you need to broaden the horizon in terms of just not focusing on the financial impact. So very quickly, in terms of myself, I started looking at social and environmental accounting, almost 2 decades ago with my honours degree, and then moved into the corporate sector and worked at Ernst & Young in their climate change and sustainability team, where I was helping companies write sustainability reports. So this is all the data that investors now look at in terms of looking at the broad set of impacts rather than just focusing on financial alone. And then from that, I also did a lot of climate change and sustainability assurance work. And I just got a bit disillusioned with this reporting. And then, that's when I heard about the Principles for Responsible Investment. So asset managers and fund managers and superannuation funds signing up to this UN initiative to say that they do want to look at deeper impacts rather than just financial performance alone, but look at the long-term impacts of their investments and look at the social and environmental or the ethical considerations. So from there, that sort of sparked me on a part-time PhD journey where I really looked at environmental social governance or ESG integration in a very systematic way over a long-term study of a fund manager, quite a large fund manager with 350 billion in funds under management. And I followed those teams around to really understand how you could take or have the emphasis on the social and environmental impacts of companies as well as, maintaining financial sustainability and financial performance. And so I ended up leaving the corporate sector, got the PhD, and I continued to do research on investors and analysts in this area of, what I call environmental social governance integration or conscious business and investment decision making. And also this year I've become a meditation teacher because I see that there's something about individual consciousness that needs to awaken. I've done a lot of work from the external perspective, from the corporate perspective, from the governance, from the big sort of top end of town. And it's actually, I think, after doing all of this research and meeting individuals, we need to get into the hearts and minds of people to make the decisions and the longer-term decisions being changed. So my future research is looking at bringing my two worlds together and running experiments with investors, teaching them some meditation and over a long period, and seeing then if that will impact the way they make decisions, not only for financial benefit, but also for the social and the environmental benefits as well. So just a little bit more detail on my PhD study and some of my research, because I know people may be interested in that. The PhD was a longitudinal case study over a 3.5-year period, and it took me. There was one of the teams was headquartered in Sydney, the other one was headquartered in Europe. So I went and followed different investors to client meetings, company meetings, investor presentations. All the sorts of things that the analysts and fund managers do to really, it was a very deep case study rather than just looking kind of at comparing the financial performance and how the fund performs and so on. So there was a lot of detailed work, 62 interviews, 65 meeting observations and document reviews. And I really understood this phenomenon of now what's quite common in the investment circles of ESG integration, and looked at the history of the principles for responsible investment as well. In terms of the two teams, the kind of, surprising finding was that the team that had the more kind of quantitative approach to their own particular, the way that their investment style, that particular team, when they came to wanting to integrate this social and environmental information, they would go to an external data provider, get a rating, and somehow try to plug that number into their particular, stock company valuation spreadsheet. And that, there was a whole lot of issues in terms of that. They would outsource the ethical or the social environmental considerations to another team member who wasn't really part of the core investment team. And there was issues with trying to get the spreadsheets to talk to each other. And in the end, we wouldn't say that it was very well integrated. Also, the number that was sort of assessing the company in terms of this social and environmental performance was just a rating, so it wasn't really expressed in dollar terms. So that also, obviously, that the numbers couldn't talk to each other. So there was some issues around that. The second team that took a more qualitative approach, they were obviously very interested in making money, of course, but they were also looking at ESG in terms of not trying to make it into this number, this magical number, but rather looking at the qualitative aspects. So they would go and have interviews with company management and CFOs and even staff on the ground to understand what sort of risks were being managed, how they were being managed in terms of social and environmental risks. And they would also look to invest in companies that were doing great things for the greater good. So a similar approach to some of the Morphic investments as well. So that was the longitudinal case study. And so I've continued to research in the area of investors and looking at decision-making in terms of a broader scope rather than just financial performance in the short term. And so a current project is an experimental design where we are presenting investors with different types of environmental social governance information alongside the financial information and seeing if we put an actual dollar value on a particular environmental issue, will that make the investors pay more attention to that information and put it into their valuation of the company rather than it happening ad hoc after we've seen a major oil spill or something like that happen. And then also I'm working with asset owners as well, superannuation funds, and looking at how they take on materiality assessments of companies and so forth. And then longer term, as I said, I think the more and more I'm in this world and meeting investors and analysts all over the world, it's about actually changing individual consciousness. And so I'm bridging my worlds of mindfulness and meditation, and going to be then seeing how this can affect the decisions for the future generations. Seeing if we raise an individual's consciousness through a meditation technique, will that change the way they look at a particular company and the effect or the impact that that company is having on the community and the environment, etc. So I'll kind of just end with this idea that I really like. It's about being authentic investors. It's not just about the short-term money-making aspect. It's really, as I'll sort of just paraphrase some of this quote from Rob Lake, who was one of the kind of early adopters or early pioneers at the Principles for Responsible Investment. And it's really, it's really time to wake up to what really drives change in people, organisations and systems. Of course, we need a business case and better numbers, but it's really about mindsets, values, vision, heart, soul, spirit, not right brain, not just left brain. Personal authenticity, courage, purpose and leadership, and the energy that comes from aligning our inner and outer worlds more fully. And so I really, I think what I'm hearing what Morphic are doing is certainly in this kind of direction. So thank you, and I'm happy to take questions at the end or now.
Should we do it at the end?
At the end, sure. Okay, thanks.
That was an absolutely excellent presentation. Yes, you always want the soundbite that captures what you do. And I always say, and I'm the father of a 21-year-old daughter and an 18-year-old daughter, so this is my perspective on it, is that I really think we need to invest. So if we do get richer, we're not doing it in a way that makes the world a poorer place, because it's all very well for me. I'm 61 years old, but I've got kids who are going to be reaping the whirlwind if we don't invest responsibly now. And that's my perspective on it anyway, in very simple terms. Just a bit more about us, for those of you who don't know us so well. Morphic Asset Management was founded in 2012. My co-founder, Chad, and I spent many years at Hunter Hall. In fact, I was there from 1997, so we spent a very long time there. Hunter Hall was really one of the pioneers in its heyday of so-called ethical investing, as it's called at that time. So we've been doing this for a fair while. We currently run 3 funds. The Morphic Ethical Equities Fund, the listed investment company that I know many of you are investors in, the Morphic Global Opportunities Fund that I know some of you have some money in, and also a new fund we've launched in Europe, which is called the Trium Morphic ESG Long Short Fund. Our objective is to provide our investors with global equity exposure in a risk-managed framework that, as I say, will allow them to become richer but not in a poorer world. I should say that since we launched, we've been lucky enough to be up over 16% compound since we launched. Now, I think you've probably got a much better idea than you had when you started, if you had any ideas about you've learned a lot about responsible investing. But I'm going to talk a little bit more precise about what it is we do, because there are many variants, and it's very important people understand exactly what we do in that complex world. When ethical investing, I use that old-fashioned term, first started, it was really driven by people like church bodies who had very specific views about about moral issues, and they were principally focused on the evils they saw wrought in their communities by alcohol, tobacco, and gambling. Those were the three things they were most concerned about. So they said, we're not going to invest in any companies engaged in those activities. As time went by, that list of so-called negative screen things you wouldn't invest in under any circumstances, increased, and I'll go for the full list of the things we don't invest in. It adds up to about, Jeff, correct me if I'm wrong, about 8 to 10% of world market capitalization that we just won't touch. That includes, by the way, oil and gas companies, and I can safely say that I've never invested in any oil and gas company in my entire investment career as a fund manager. That's true actually. And then the second, more recent element, as alluded to by Anna, is what's called ESG investing. And this is not so much about what companies do as the way they do it. So it's like a deeper dive. ESG, environment, social, and governance. Now, most of the environment, the companies that have a big exposure on the environment, we already exclude, to be honest, through our negative screen. So it really comes down to social and governance. Social, it typically, in my view, relates to treatment of employees or customers, and also activities of the supply chain. So many of you remember there was a terrible fire in Bangladesh a few years back where a high-rise building full of ladies virtually chained to their sewing machines got burnt, got killed in a fire. And I think that was a real shock to many garment manufacturers. Who is in our supply chain? And we definitely try to look through that supply chain where we can. And then there's governance. Governance is about how the company is run. Are the benefits of the company's business flowing to the shareholders, both in the short and the longer term? Has the company got inherent weaknesses that blind it to the risks it's taking? I think many of us in Australia will be aware of what's happened to the AMP recently. You could argue that was a board that wasn't fully prepared for some of the risks that the company was taking and was really almost turning a blind eye to some of them. So what we try and do is what's called ESG integration, and something Anna alluded to. And the way we do this is that every company we invest in is subject to what's called an ESG audit, which is a series of additional questions that go beyond the purely financial to look at the risks involved in that company, from the way they conduct themselves in relation to the environment, social issues, and governance issues. Now, very important point, we don't expect everybody to be perfect, particularly on the governance front. In fact, to be honest, I think there's more upside in people being relatively imperfect but getting better than being perfect in the first place, because you know what perfection's like. It's very hard to get any better than that. But when companies have got flaws that they've identified and admit to and trying to deal with them, that's actually a great opportunity for us. Finally, the other trend that we're engaged in this matrix of issues that come into modern responsible investing is what's called sustainability issues. And what we do there is we say we're going to commit to having at least 5% of the fund. Typically, it's more like 10%. 10% of the funding, which is engaged in investing actively in stocks that are trying to make the world a better place, or doing things that inherently will make the world a better place. And I'll talk about some of the stocks in our portfolio in a minute to give you a bit more perspective on those kind of companies and the opportunities we find there. I hope this comes as encouraging. The fact is, this is a growing trend. The broad figure is globally about the amount of total assets under management that's being managed within a responsible investment framework is growing at about 25% a year. And I think it's growing because it's driven by what young people want for themselves, but also, for those of you who've got young people in their families like I have, it's what young people are telling their aged parents to do. Very aged parent in this case. So I said before, we talk about some of the things we don't do. We don't invest in companies involved in alcohol, tobacco, and gambling. We don't invest in companies that involves in armaments. We don't invest in fossil fuels. We don't invest in the nuclear fuel cycle. And we don't invest in companies that do factory farming or involved in deforestation. Some people will say, well, why don't you invest in nuclear fuel? That's a fantastic thing. That's saving greenhouse gases. Well, I've got to say, as a person who's invested in Japan for many years, the shock of Fukushima, which came after 3 Mile Island, I can't remember, so long ago now. The number of miles is expanding, and also what happened in Russia. We just know when these things go wrong, they go so badly wrong. Any possible benefits are really overridden. Plus, I don't think anybody's yet got a real feel for the cost of closing down a nuclear power plant. I said we do positive screen investing as we try and invest in companies that are trying to make the world a better place. We're really most focused there on companies that are involved in trying to make changes in air quality, water quality, and where we can on things like renewable energy. We find the best opportunities tend to come in things like water quality and air quality. And one of the biggest investments in our fund at the moment, which I'll be talking a bit more about in a minute, is a company called Alstom, which is a French company that makes trains and trams. Any of you who've just crossed that mess in George Street, they're not responsible for that, but they will be building the trams that go up and down it. Why are we so positive about that as a sector, part of our positive screen? Because if you go around the world, cities are basically drowning in cars. If you go to the developing world, they're absolutely drowning in cars. And so the the opportunities to make money from that trend of building more and more public transport are great. The benefits from it for the environment are also huge. Just going to talk briefly about our portfolio positioning. This is as of end of June 30. Our biggest position, as I said, is Alstom, and I'll talk a bit more about it in a minute. We have a lot of stocks in Japan. We think that these are very cheap stocks that are associated with the real estate sector. But one of the things we do as a fund manager who's very focused on risk is that where possible we try and find companies that are good at what they do and a similar company that's not very good at what it does or has challenges from the point of view of governance or similar issues. And what we do is we pair them. We have one that we own and one that we don't own, and we match them off. So Open House, for example, we match off with EDA, which is at the very bottom of the list. The stocks that are in gold are what we call our short positions, where we sold them to do some hedging, typically. I won't go through all these stocks, but I will talk about, in a minute, Alstom, Open House, and Coca-Cola Amatil. So Alstom is a world leader in transportation, in public transportation. They build both high-speed railways, they build trams, and they build subway systems. French listed, about to merge with its major competitor, which is a subsidiary of Siemens called Siemens Mobility. It's been a very, very successful investment for us. We expect it to continue to be. We're about to get paid €8 a share for a premium for the merger and for a cash return prior to the merger. Bit of context, Alstom's been around for a very long time. It has never, ever had a higher order book. That's the amount of work that people want to do over the next 5 years. And its margins are approaching record levels because it's got so much work to do, it can actually charge the price they want to. I don't know if anybody here has recently been to Delhi or Beijing. If you go to those cities, you immediately understand just how huge the opportunity is in public transportation. They're a global player. They may be based in France, but they have operations in every continent. And they're what you might call their technology is typically developed in France, but the manufacturing is done locally, which makes them a very attractive partner for emerging markets, countries who want to have some local manufacturing. How innovative are they? We're very excited about one new piece of technology they've developed called the hydrogen train. Why would you need a train that's powered by hydrogen? The reason is because all over the world people are trying to remove diesel from their rail systems. If you've got a very big route, that's quite easy, just electrify it. But if you've got a small route that's going through a series of sleepy villages in rural Germany, you really can't afford to electrify it. So what you do is you replace your diesel engine with a hydrogen engine, and that has zero emissions, whereas diesel is pretty dirty. This is a newer stock that we just recently started buying in the fund. It's got a great name, China Water Affairs Group, but they have a very simple business. China is one of the world's most wasteful countries in terms of its use of water, and it's also one of the countries with the biggest shortage of water. So there's you can already see there must be a pretty good business opportunity there to try and close that gap. What China Water Affairs Group does is it goes to local authorities in smaller cities and says, you've got a problem, which they already know, which is that basically they're providing a water supply system that's not running very well and it's costing them a fortune. So what China Water Affairs Group says is, if you let us privatize this, you can keep a 40% stake. We'll take 60%, and we will invest in capital expenditure to actually make the thing work better, and we'll turn it from a loss maker for you, which requires constant investment, to a dividend-paying company. How do they do it? There's a one-word solution: leakage. Now, when you hear the word leakage, you're probably thinking about leaking pipes. Some of it is that problem, but most of it is the fact that typically these smaller municipalities don't have meters so houses don't have meters, and they don't even have proper billing systems. So what they do is they install meters, they install a proper billing system. Suddenly people are less wasteful of water because they're having to pay for it, which is a good thing. And an opportunity that was a loss maker has gone to a profitable business. Now, as many of you know, we do also short, and we can short stocks that we find that are in our excluded list. One of those stocks that we are currently shorting is a stock called Coca-Cola Amatil. I'm very tempted to invite Chad up here. Chad, come and join me. Come and join me. This is one of the ideas that Chad has had in the portfolio, and he's totally prepared for this, by the way. But exactly. So this is Chad, my co-founder, who's going to talk about Coca-Cola Amatil.
Afternoon, everyone. Look, most of you, because this is the Australian listed bottler, in other presentations I've done, often people are shareholders in the stock because they do pay a fairly high dividend yield. Now, you're probably aware of what they do. They make Coca-Cola beverages. Now, the biggest thing in Australia at the moment in the Western world is this talk of a sugar tax. Now, so they're under a lot of threat at the moment, and you've probably seen some press in the SMH. Their chairwoman has been on the front foot to try and defend them by pointing out sugar tax won't address much of a problem, etc. Obesity is not really caused by drinking carbonated beverages, etc., etc. So they sell a product that is in decline. On average, carbonated soft drinks demand is falling about 4 to 5% a year. So what they've been doing is putting up pricing. So think of it a little bit like tobacco. That demand for tobacco has been falling for many years, but what they've done is they've put up prices to offset it. So they've got a couple of things coming together at the moment, and then also this year as well, you may recall New South Wales brought in a recycling levy to get the plastic bottles recycled. That was a 15 cents per bottle charge as well. So they had to wear that, and they passed that on to consumers as well. So in a good business, you have your revenue growing and your margins growing. I'd say in a bad business, you have your revenue shrinking and your margin shrinking. At the moment, Coca-Cola is sitting in the junction of a number of social forces as well as end demand. People just don't drink as much Coca-Cola. Now, what you could then consider is, if you may be aware that Coca-Cola Amatil buys its syrup from Coca-Cola in the US. So Coca-Cola in the US, they can just put up pricing. Whereas Coca-Cola Amatil doesn't have any of the great moats. You might hear about moat investing or barriers to entry. They have none. They're a price taker. They're told by Coca-Cola US what they have to pay for their syrup. So they're in a really tough situation at the moment. They're paying out about 100% of their cash flow in divvies to shareholders who want dividends. So they don't really have much room to grow. Now, the other two areas of their growth has been Indonesia and Papua New Guinea and Fiji. Now, this is the social side of things that came up when we were doing the ESG audit that Jack alluded to earlier. We noted one thing which we put to the company. Now, we try to engage with all our companies, longs and shorts. We try to give them a fair hearing. We put to them that we noted there was a bit of an oversight in their annual report. They didn't appear to have included Indonesia and Papua New Guinea and Fiji in their sugar reduction targets. If any of you are a shareholder, you should bring it up at their AGM. What was there? We missed something. And they said no. We're like, so Australians are worthy of having a reduction in the total sugar consumption, but the poor people of Indonesia and Papua New Guinea, well, they can keep having as much sugar as we feed them. And he said, no, it's not like that. I'm like, well, can someone please explain to me what we're missing here? And it appears that, to us, these are what you call a greenwashing firm. They've come out to say in public that they actually care about a number of these issues, but they don't seem to care that much. We also put to them in the meeting that they considered getting out of the sugar business. Because if you consider some of the tobacco businesses, what they did was they changed their business and they used the cash flow. We said to them, look, this isn't your problem in the sense that this is a legacy business, that your business is actually distributing other beverages. Mount Franklin, if you're aware, is one of their brands. It's a leading water brand. You can move your distribution into other businesses. And they said, no, they're not considering that either. So nothing we felt in our engagement was this was a business that wanted to be on the front foot and actually be ahead of change. It seems this is a business that wants to fight change, wants to lobby the politicians, and wants to spend money on doing a tobacco-style regard action. So put those things together, we have the ESG angle, and we also fundamentally think on a PE of 18 to 19 times come earnings downgrade, and you might have seen this morning that Macquarie Bank downgraded their forecast for the stock. Citibank downgraded their forecast last week as well, that the stock is not doing that well. So it's not priced particularly well. It's got a bad ESG angle, and we don't think the company's willing to change. So that's how we hopefully bring together the fundamentals as well as incorporating some of these more integrated ESG issues that were discussed in the earlier presentation. So we can chat more on these later if you want.
Yeah. I should say that one of the great things about doing these trips around Australia is you actually learn a lot on your way. When we were in Perth, we learned that that the other big problem that Coca-Cola Amazon has, which is irresponsible use of packaging, is really coming home to roost in Darwin, because there's no toll on packaging in Indonesia. So what's happening now is if you're living in Darwin, your beaches are getting covered in plastic waste that's blown down from Indonesia, with Indonesian writing, including Coca-Cola bottles. And Chad and myself, quite separately, have had a long experience. Chad grew up in PNG, and I've had business interests in Fiji for many years. And the obesity issues in those countries are terrible, and the plastic waste issues are just as bad. And I think it's shameful, to be honest, that Coca-Cola Amazon is not doing anything to address those issues in those much more vulnerable countries. I talked a bit previously about our policy of trying to, wherever possible, find a pair between two companies, and it's particularly frequently you can find these opportunities in places like Japan or America. We have lots of companies doing a very similar thing, but some doing it rather better than others. And in Japan, we found a very good example of this, where we have had a long-standing investment in a company called Open House, which is a property developer in central Tokyo. We've actually owned it since 2013, but this chart just goes back to 2014. And the blue line shows the history of the share price there. The yellow line shows the history of our returns since we started pairing long Open House with short Ida. I'm sure many of you have heard of Tolstoy. Tolstoy wrote a great book called Anna Karenina, and the opening line of Anna Karenina is he says, "Every happy family is the same. Every unhappy family is unhappy in its own way," more or less. And the same is true of companies. Good companies all look quite similar, strangely enough, in terms of the way they conduct themselves. But bad companies can conduct themselves badly in all sorts of different ways. And Ede is a particularly fascinating example of a company that's not conducting itself particularly successfully. So Ede was originally, it's made up of a collection of 6 companies that were all listed in the stock market. They were all founded by one chap whose name was Mr. Ede. And Mr. Ede decided that he was getting on a bit, and he thought he should bring all the companies together into one holding company. And when he did that, he did a very unusual thing. He got his son-in-law to be the CEO of the overall business. Now, for those in this room, and I know there's some people in this room who know a lot more about Japan than I do, but generally, when a son-in-law is running the business, it usually means, and there are sons, it usually means the father's decided his sons aren't really up to it. He's often encouraged his daughter, if he has one, to marry a promising executive, and often, in more traditional companies, that promising executive will then adopt the family name and become the new leader of the family. It's a very Japanese solution to succession problems. Now, what happened here was quite interesting. The current managing director of Ede Group has not taken the family name. The original guys who ran all the listed companies, who are now running subsidiaries of that company, are still running the companies. They're all the siblings, or his half-siblings in this case. And what is incredible is the company has actually captured no synergies from the mergers. All they've done is impose an extra level of costs on top. Meanwhile, these guys who were previously running independent companies are now running subsidiaries, but nobody's told them, or at least nobody's managed to get the message through. And so they're off doing crazy things like investing in startup business in Uzbekistan and so on, which for a company that's got a slightly troubled business, because whereas Open House is operating in the center of Tokyo, Ede is operating just in the peripheral areas of Tokyo. They got troubles because that's a much less promising area to operate in central Tokyo. So we're pretty unexcited about its prospects. Open House, on the other hand, is growing at about 20% a year. We think it's a very good pair. What we do here is we take up the risk of yen, because both stocks are denominated in yen, so we've got no yen risk. We're taking out the risk of being invested in Japan. We're even taking out the broader risk of being invested in the real estate business. All we're really investing in superior quality of Open House's management over Ede's management. So that's a theme you'll see us, I think, an approach you'll see us adopting more and more as the current bull market we're in gets a little older. We're going to try and find more and more of these opportunities where we can invest in a good company and short a bad company to make gains even if the market's not going up. I'm looking at Jeff now. This is Jeff's slide, and Jeff's going to come up here and speak to it, if that's okay with you, Jeff. So we're going to talk a bit about every 6 months, we get together as a group and we talk about what we think won't happen over the next 6 months. Why do we do that? Because it's a very good way to frame our thoughts of how to position the portfolio and to try and take out some risks. And this is a really, Jeff is our risk manager. We're very unusual as a funds manager to have somebody who's totally dedicated to risk and macro. So Jeff, over to you.
Hi guys, so what we try and do here is it's sometimes a lot easier to say what you think won't happen. And then if you overlay all the things that you won't happen, you can start to consolidate a picture of what will be left that you think will happen. So this is something that we put out in our half yearly every year. We make 5 or 6 predictions for what we don't think will happen, and that hopefully narrows us down. So what a lot of people will see in the press of late is a lot of story around about the US Federal Reserve hiking. This is probably one of the most important areas when you're looking at global markets. That the old phrase is that economic expansions don't die of age, they tend to be killed in the night by the Fed. That's a classic one that Chad likes to quote. So this is why equity investors are so focused on where are interest rates going in the US, and are the Fed going to get ahead of the curve and potentially slow the growth profile down too early. Our view is at the moment they're very cognizant of where they are. This is a very solid Fed with a very solid US backdrop. We aren't seeing any signs yet that they've gone too far. Employment growth remains very strong in the US, and so things appear to be on track there. So our main forecast here is that the hiking, they won't accelerate their hike profile, and we don't think 10-year bond yields will go above 3.5%. So that's actually a pretty good backdrop for equities, because if we were to see a big sell-off in bonds and yields go higher, typically the PE or the price that people are willing to pay for earnings on stocks would fall, and that would depress market prices. Next one is US equity markets will not finish lower. We have around about half of our portfolio in the US as a global investor. Ultimately here at the moment, the backdrop is very solid at a foundation level. Global growth continues to be above trend. It continues to move forward strongly in the US, strongly in Europe, and China is continuing along its measured slowdown. At the same time, the Fed, as I've just mentioned, isn't hiking at an accelerating rate, so that appears good. So your bedrock for your financial markets is good. What you have at the moment, which is the first time in the sort of last decade or so, is politics is starting to come into play. So you've got these cross currents in global markets where the foundations are pretty rock solid, but you've got some sand getting thrown into the engine, as it were, which means that markets are currently in this sort of chop backwards and forwards. But ultimately, what we think is that the actual earnings and fundamentals will come good, and we should start to see stock markets over the next year or two continue to break higher and make new highs. Credit is something that we watch. Credit is basically looking at what is the bond market charging corporates to borrow money. What typically happens in most cycles, as you look over the last sort of 30, 40 years, is credit prices, either price that the bond market is forcing borrowers to pay, typically tends to start getting more expensive around about 2 to 3 years before you see a top in the equity market. So this is a very good forward-looking indicator of where we are in the cycle. So we think we've potentially seen the lows in those, which is also part of the Fed starting to hike, and that's an area that we're keeping an eye on. We don't think we'll go back to sort of the cheapness that you've seen in credit in the US. Next one, Trump's ratings will not collapse. It's hard to wake up in the morning without seeing some sort of headline relating to Trump. Our base case is ultimately Trump will get caught out somewhere or another, but we don't think it's quite yet. A lot of the policies that he's putting in place ultimately are still very popular with his core voter base, so we don't think this is the half where he sort of falls out of fashion. And then Australian shares will not outperform global shares. This is one of Jack's ones. We tend not to look too much at the Aussie market, but our general view is ultimately the rest of the world looks a lot more attractive than Australia in terms of where we are in the cycle, and we think ultimately that will come through in share prices.
Thanks, Jeff. Fantastic. Thank you. just a bit of why do we care about Trump's ratings? Because, frankly, in my view, as long as he remains at sort of 35% plus approval level, he won't do anything truly crazy. That's my thinking on life. But if he was to become deeply unpopular, then I really worry about what might happen. And with Australia, why do we think Australia won't outperform global markets? Well, I think there's really two elements. One is the Australian dollar. We think that if these trade problems with China continue, which I think is probably likely, then the Australian dollar will fall. I mean, the Chinese renminbi has fallen by nearly 10% against the US dollar in the last few months. The Australian dollar has fallen a bit, but not nearly that much. There's probably going to be a catch-up at some point. And then in terms of the shares, the very nature of the Australian market, in my view, makes it very vulnerable at this time. It comprises the major exposures are to banks. And I must say, over the weekend, I learned, you learn important stuff. Over the week, just talking to other investors and so on, I am shocked at how hard it is to get a bank loan now. I think that the Australian banks are going to struggle from the point of view they're not going to grow because they don't want to lend any money because they've got so nervous. That's a bad thing. Their margins are probably going to get a bit squeezed because the Royal Commission is going to impose a whole lot of costs on them they didn't have previously, which they probably should have had in the first place. And then they're going to start getting bad debts because the rate the house prices are falling, sadly. Speaking of no great joy as a large house, as a owner of a large house myself, is really quite catastrophic. And I mean almost catastrophic because the banks won't lend to anyone who wants to buy a house. I'm sure we've all had this experience. You've all heard anecdotes about this, and I've heard so many lately. It's kind of scary. So banks, big chunk of the market, they're going to struggle. I think resource stocks. There's a bit of a paradox here. I can't remember a time when Rio and BHP were probably better managed and more rational. But they ultimately are dependent on the prices they get from their commodities. And then retail, I don't think it's going to be a tough time for retail. It's not a big sector in the market because as people's houses fall and they start getting nervous, people tend to consume less. And then there's a six-letter swear word beginning with T. I'm sure many in this room sadly will have an experience of called Telstra. We just don't think it's cheap enough yet. So if you take those, that's probably about 80% of the market. How can that collection of stocks outperform global shares? I'm going to probably hand over to questions, I think, now, if that's okay with it. And I think I think we'll hand over to questions. One thing I should say, this presentation is in your bags. On your chair, you should have a jute bag. We got these bags to reflect the fact that you can't use plastic bags in the supermarket anymore. Please carry them with pride around your local shopping centre. If anybody asks you, tell them all about the Morphic Ethical Equities Fund and what a fantastic bargain it is. Also in there is a copy of our 6th monthly report to investors. You should all get this online, but there's a hard copy in there. And there's also a couple of stories about things that Chad and I have been up to recently. In particular, a story about a battle we're having with one of our Japanese companies through this so-called engagement process where we're asking to actually pay us a decent dividend and buy back some shares and not do anything stupid with their cash. So, questions? That was quick. Do we have a roving microphone or not? Okay. So could you speak up because we are filming. Well, we are filming this for investors who couldn't make it here today.
I'm looking at the half-year report.
Yes.
And you've got the Morphic Global Opportunities Fund, and then on the other side, the Morphic Ethical Equities Fund. Am I correct in assuming that the only substantial difference between those two funds is that the one on the right-hand side is a listed fund on the ASX, and the one on the left is just a unit trust? Is that the only substantial difference?
Pretty well. There is one additional difference, is in that we are, if you like, if you call sustainable investing call it a range across green, we're a little bit greener in the MEC because we have a permanent short position on fossil fuels there. So we're always underweight fossil fuels. So that has been a bit of lead in our saddle for the last few months because the oil price, as many of you will know, has gone up. We expect over time it's going to be a tailwind for us, but we have always warned people that from time to time it will cause increased volatility and we may underperform because when the oil price goes up, oil stocks tend to go up as well. That's the only difference.
All right. I'll ask my other two questions after other people have had a chance.
Back there.
Yeah.
Can you speak up? Sorry.
Okay, yeah, sorry. You say that net asset value is like 116, the share price is 102. Have you considered doing share buybacks? That's the best way to invest in case of values.
Yes, look, we have considered that. We have one of our independent directors in the room here. Where's Virginia? Wave your hand. Virginia, right next to you. There we are. No, we have considered this. Our view is that because the fund is a little subscale anyway, we'll be imposing quite a lot of extra costs on the fund if we shrink the share count further and the asset base further.
Yeah, how big is this options overhang you've got?
Yeah, that's probably a factor too. I mean,
That's a factor. I mean,
yeah.
That'd be pretty risky to buy those now because of that. wouldn't
The
it?
options, you mean?
No,
The share.
buy your shares now.
Yeah. Look, I mean, we have roughly 9 options for every share we have outstanding. They expire at the end of November. We obviously hope they get exercised, both as a manager and as a director of the MEC, because it reduce the operating costs of the fund. The shares are exercisable at $1.10. As I say, it's frustrating for us when the NTA is about $1.16 and the shares are trading at $1.03 or so. We feel that we'd love the options to get exercised, but clearly it's based on the share price, not the NTA.
Do you regret issuing the options?
It's a good question, actually. It's a very good question. When we were discussing with...
Yes, could you repeat the question now?
The question was, do we regret issuing the options? When we were looking at launching the fund, a lot of our friends in the press were saying, for God's sake, don't issue any options. But I think we're probably, with the benefit of hindsight, right. But the stockbrokers who supported us in the transaction said, we're not doing the deal unless you issue some options. So we really had very little choice. And it's interesting that recent funds that have been launched are being issued without options. So, but unfortunately, we were a creature of the time at which we did the float and what was expected of us by our stockbrokers and what they felt the investing public wanted.
I've also got a bit of a crisis in logic here, that you're an ethical investment fund and therefore you screen out, say, fossil fuel companies and Coca-Cola and so on, and yet you're perfectly happy to derive a financial benefit and profit from those companies by shorting them. Because when you sell a short position, you're supporting the price of that company and profiting, because you have to buy those shares back in order to send them back to the borrower. So you're deriving an economic benefit from the existence of unethical companies. So how is that ethical?
Okay, well, this okay. So did everybody get the question? I've got to say, fundamentally, I don't agree with what you're saying, but I do think it's a very interesting question. So just a bit of backtrack. What happens when we short a company? We go to our stockbroker, one of our stockbrokers, and say, can you find someone who will lend us some shares? And typically it'll be someone like Aussie. It'll be you guys, by the way. It'll be one of the big superannuation funds like Aussie Super or something like that, who owns those shares because they don't care about these issues, and they own them and they lend them out. We pay some rent to borrow the shares, and then we then sell them. So we never really own them. We get the shares and we sell them within a few minutes. And we hope to profit, as you point out, from being able to buy them back later at a lower price. And we do this because we believe that the business is unsustainable or overvalued or both. In this case, both. And once we've done it, we then get on our soapbox and we tell the world why we think this business is unsustainable and bad. And we think that once that is reflected, in many cases, we think it's going to happen because they're forced to recognise the costs of acting more ethically, which will fundamentally damage their profitability.
You're participating in the market, and you're actually participating in the market by trying to manipulate the price low in order to derive a benefit.
Well, we never manipulate prices. We never manipulate price. That's both illegal and
you're trying to
probably
talk
not possible.
it down, though.
We're trying to explain why we think it's overvalued, but we think it's part of our armament. We think it gives us a soapbox to speak from, where we're not just a passive bystander. And we also don't think, for what it's worth, we're not adding any sucker to the enemy. Well, unlike Mr. Trump.
You do own them, if only momentarily, because you have to buy them back in order to give them back to the lender.
Well, the minute we buy them back, I'm not actually sure we ever legally own them, but I think they actually immediately get passed back to the original owner.
I think you've got a bit of cognitive dissonance happening. I don't understand how that's ethical.
Well, the whole subject of ethical investing and shorting is very grey area, isn't it? Whether it's ethical or not.
Ethical itself, some people believe is unethical.
Regardless of
Well,
Shorting itself.
look, can I just say so? We don't agree with that view. We know there's many views. We can only tell you what we agree, what we believe in, and we are very transparent about what we do. Chad wants to come up and address this issue.
I'll set up your
At the same time, you're flying around the country on the proceeds of the fossil fuel industry that you won't invest in.
Look, I think the most important.
Come on.
The horses don't work very well anymore.
Just before we get off this, because I've just spent 6 weeks in Europe over the course of this year marketing the ESG fund over there. I think there's a couple of issues being conflated here. Is that there's ethical investing in ESG, and that's why we tried to show the difference. Your ethics are your values, and so if you're the church, and I pitched to the church commissioners in London. They take your view, which is the shorting. They cannot profit from that, whereas we see ESG as a holistic thing. What are we trying to achieve here? Like when you say you don't want to own a coal company, what are you trying to achieve? What do you want?
Someone else will own it.
No. I'm assuming we all want to have less coal used. Isn't that what we want? Okay. Shorting is a way of profiting and publicising, and hopefully, if there is less coal used, you profit from that. Like what we want, and that's called driving up the cost of capital. If their PE goes to a PE of 3, it's going to cost them a truckload to go to Westpac to borrow any money. Adani's not going to get lent to, and the outcome that we all want is less coal. Whereas
if you drive the price down, it's a cheaper buy and more people will buy it.
So you work more on negative sentiments, isn't it?
Yeah. So, but when you buy shares, when we buy shares in China Water Group, we're saying this is a good business. We want its PE to be higher. We want people to pay more for it so they can raise more capital, so they can do more good things. It's the inverse. And so I see this as we're trying to deliver outcomes. Outcomes is what I want, rather than just a soapbox. And I don't think divesting is the solution, because to your point, someone else will just buy if you divest. Is that shorting is a very appropriate tool, and that's one of the questions I was going to ask.
Driving the PE up just increases the risk.
No, it lowers their cost of capital. So the reason why Tesla can exist as a $55 billion business, and I'm not here to just debate whether Tesla is worth what it's worth, is it's very cheap for that business to fund itself. Now, is Tesla doing a social good? Arguably, yes. And now, I don't want to get too much into specifics of every single stock that we go through here, but I have no ethical qualms. And if there are plenty of long-only ethical managers, if you take that stance, that shorting is an appropriate tool in capitalism to get the outcomes that we all want, which is less carbon, less global warming, and better treatment of staff. That's what I want.
Okay.
Can I just say, when you short a company, you never actually own any assets, so I think that should allay the fears of this gentleman here.
Well,
when you short a company, you do not own any assets whatsoever. You're only owning a contract.
Yes.
Correct.
So
That's quite
you're
correct.
never, ever owning the company.
Yeah.
So I think that should allay his fears.
Can I just say, look, we do know that you can't be all things to all people. So what we've tried to do is to identify what we believe in ourselves, hope it finds a common ground with many other people, but be very clear about what we do, because we know we can't be all things to all people. Sorry, over there.
Okay. When you're shorting the share, you say you got conviction on that point, shorting Coca-Cola or whatever. How far do you go on that if the share price go against you? How far would your conviction go? You chicken out next on 10%, what do you just continue holding up, or what do you do?
Okay, that's very good. Well,
if you have a conviction, you just stick to it then, till either you die or they die.
Well, unfortunately, I just say it's not. Hopefully, it's not a question of.
How are you going to handle it? I mean, you say you got conviction, but you chicken out, but 10% down, whatever. You're not going to.
Okay, well, hopefully, it's not a question of anybody dying. But what we do want to make sure is we don't lose too much money for anybody. Our shareholders and the unit holders. Okay, so
opportunity.
I'm very glad you bring it up, because it does bring up the point that we operate everything we operate, every position we have is operated with a stop loss, because from time to time, I know it's very unusual for a fund manager to admit this, but from time to time we'll be wrong. And when we're wrong, we want to have a quantitative measure that indicates we're likely wrong. And if you look at the chart, if I can just show you here, if I can. If you look at, I don't know how well you can see this, but I'm going to come over here and hopefully not get in the way of the projector. But you'll see that we did actually have this idea around here. And we did stop. We were shorting the stock and we said, this is not working. We then had another go here where it's worked a lot better. And the reason for that is when we think things are going against us, we will cut the position. But it doesn't change our beliefs, it just changes our view about whether we're right at that time.
And just also be clear, there's a blog, if anyone wants to read, we wrote last year. If you put 2% of all of our money, our NAV, into a long position and it goes wrong and goes to zero, the maximum loss is 2%. If I short 2% of a company and it goes up 100-fold, we don't exist anymore. We're bankrupt. So conviction on shorting will kill you, if you want to keep using your phrases. So conviction is a bad thing in shorting. It's like
some of those short sellers in America, those sort of hedge funds, things like that, they do go through it, and you people, this is not a conviction, it's just opportunity for you.
But shorting is a different mindset, and I suggest that you read the blog. There's some conviction can serve you well in certain circumstances and can serve you very poorly in other circumstances.
Right. And
sorry, just a question about unlisted companies. Do you invest in any unlisted companies at all?
No, we don't. And I think so that's one of the reasons why we find it very hard to invest in renewable energy, for example, because a lot of those opportunities are actually in unlisted companies. Sorry, go ahead.
How do you select the companies? Do you go back to their 50, 100 years history? Because Alstom is once upon a time was involved in defense things, because I personally was involved developing one product in Australia with one local Australian company.
Yep,
I don't know whether they're out of it, but they're still, as far as I know, they're manufacturing nuclear power stations. They're putting in. No.
So you're absolutely right. The history is that. But basically, Alstom, I'm going to use a very loose term here, nearly went bust during the GFC. They were forced to basically exit everything except mobility. They have some passive joint ventures with GE, which with all the parent, which they basically, it's just a cash investment. They're going to get paid by GE in the next couple of months, cash. So it's basically a deferred settlement. So all they are now is a mobility company. You're absolutely right. Used to be a very complex, kind of a mini GE, if you like, in France.
And do you put money in clean tech? I mean, current clean technology, clean tech. A lot of clean tech companies.
Yes. Look, our view is that, we don't have a natural expertise in what I would call cutting-edge new technologies. It also tends to be very high risk. We don't think our investor base wants to invest in that. But we have invested in companies, and we'll continue to look at companies like a company which unfortunately we did lose money on, which was China Everbright International, which is a waste-to-energy company that takes municipal waste, gets paid by the local authority to provide an alternative to landfill, and then burns it in a very, very modern incinerator to generate energy. So we're very interested in those kind of companies.
Doesn't emit CO2?
Sorry?
Doesn't that emit CO2?
It does, but much less than leaving the stuff in. There's a problem.
Like clean coal, less CO2.
Well, the difference is clean coal, if you leave it in the ground, doesn't emit very much CO2 at all. If you put municipal waste in the ground, it emits lots of nasty gases and pollutes the water system. Sorry, can I just ask the guy in the red head had his hand up before?
I'm very interested in your theories as to what's caused the share price to be so far below the net asset value. I've heard one view I think is a great overhang of options. Another one might be, another one you've mentioned is that Jeff Wilson isn't buying. And the third one might be that the fact that you're comparing your returns with the MCSI as your benchmark, whereas all the things that you've told us today is that you're not like the MSCI. So why are you using that as your benchmark? Why not stress the fact that you've made 11.5% over the last 12 months, which is a very good return, and then perhaps give us some reasons of what you're not investing in, which you made a lot of money, and perhaps to explain why the MCSI is a little bit higher than yours. Or is it something else?
Now, are you retired or do you want a job as our marketing? No, and also the options are. Why are our shares trading discount? I could give you my views, a summary of all the views. We're new. There's the option overhang. I think that we're relatively small. Jeff Wilson has been out marketing a new fund, a global fund. He had a lot of investors who were in a lot of his followers invested in our fund. There was undoubtedly some churning, where people just quit our fund and bought his new fund. And then I think performance is probably not the most important. The fact is we are, as you point out, up 11% roughly since we launched. We have been out telling the world about it. We need a bit more. I think we need to release our inner Jeff Wilson a bit more and just tell them what a huge bargain it is. But we'll be lifting our game.
A comment on that, your June, the top, I think the first chart you're showing on the top of your page was your comparison to other MSCI.
Well, look,
do it somewhere, but not at the top, which just leads every.
Well, I do like to be very transparent, to be honest. I mean, the reality is we were doing really well compared to MSCI until the end of March. Then the oil price really took off. That has been a major contributor to our underperformance. We've always warned people that may be an issue. The oil price has started to subside a bit. Hopefully, we'll get some of that back. Sorry, there was. Sorry.
I just wanted to ask regarding your pool of shares that you would purchase. Could you give us an idea? Let's say we took the ASX 300. What percentage of those shares would you be prepared to buy?
Gosh, you're probably asking wrong people. Let me give you a little bit of perspective. We don't invest in companies with a market cap of less than 400 million US. So that will cut out quite a few of the shares in the ASX 300. Secondly, we don't invest in companies that haven't got high liquidity. So we require at least $3 million a day, US $3 million a day of daily turnover, because that's for our risk management process. So, Chad, have you got a rough guess of how many shares we could buy from the ASX 300? And leave your side screens.
Or 200 then.
I think
I'm just looking at
it's like
what's available.
Yeah. So Australia is the classic example that we wouldn't own because it's so resource heavy and mining services heavy and stuff. I think it was 60 or 70 out of the 200 have some sort of mining or oil and gas or any of our 5 major exclusions. But oil and gas and mining are the main things we wouldn't be in. So it's a high ratio in Australia compared to somewhere like Japan, which has a lot less mining companies.
So globally, you're saying you've got more choices?
Yes.
Yeah. Running this strategy in Australia would be challenging, just doing an ASX 200.
We think it's about 8% of the world market we can't invest in. You'd be surprised how much of that is tobacco stocks. When Jeff and I were doing all the analysis of what we couldn't invest in, we were amazed how much it was tobacco stocks. Tobacco is a huge amount of global market cap. Alcohol's a little bit. Gambling's a fair bit. Boeing and Airbus are a reasonable chunk, and then the oil and gas sector.
So you don't touch Boeing or Airbus either?
No.
No.
Believe it or not,
You flew up from Melbourne, though, didn't you?
for what it's worth, I didn't. Just for what it's worth, by the way, Airbus. I was shocked to discover Airbus has a far bigger exposure to armaments than Boeing, which was a big surprise to me. I didn't fly up on a warplane. I flew up on a civil aviation plane.
How do you measure, the successfulness of ESG screens?
The question was, how do we measure the success of the ESG screens? And my view on this, and Anna and I have a different view, and I'm welcome to cut in, Anna, is that essentially what we do with our ESG screens, we're trying to look at risk factors that aren't necessarily identifiable from share prices. And so over the long term, we hope to get some value from those issues. Now, BP was a very interesting example because, as some of you may recall, BP briefly rebranded itself about 10 years ago as Beyond Petroleum. And so what BP did was all these oil companies, by the way, have had a very clear view about the risks associated with being in the oil and gas sector, and have been trying to find succession businesses for that, because they know it eventually is going to come to an end. But they were very engaged in what Chad refers to as greenwashing. They spent, given the importance to their business, they spent disproportionate amount of their time in their annual reports talking about all the good things they were doing, all the issues they were trying to face up to. So it's very hard, to be honest, to always see the risks from ESG auditing. So that's one of the reasons why I think it's better just to stay away from an investor perspective. But there are things you can look at. You're basically looking for things like, is the company an outlier in terms of its board representation? In Australia, we're used to now the idea that we're moving towards gender balance on boards. I'm happy to say the Morphic Ethical Equities Fund has got 2 female directors, 2 male directors, and a female chair. So we're at least preaching what we're talking about, or doing what we're preaching there. But if you go to a country like Australia, you find no female directors, a high majority of management on the board, then you probably see an outlier, probably is a cause for worry. So those kind of things can help. In Japan, we're looking for companies that are making those very early stages from being very badly governed to being a bit better governed. We hope that will add value over time. But it's going to take time to be absolutely sure what we're doing makes a difference. And one thing I will pick up that Anna also commented, the data providers are very, how should I put it, they're very inconsistent in their approach, and they also don't provide coverage for most of the mid-cap stocks we invest in, particularly in Asia. So we have to do it ourselves.
About the dividend, I read here, I think, and you said it's going to be 1 cent per share in August?
Yes, that's correct.
Is that likely to continue now at that level for some time? And quite frankly, I'm a dividend investor, but I also love ethical investing. I'm just wondering if I can put the two together. And I'm also wondering whether maybe the Global Opportunities Fund is paying more. Is it paying more than the ethical fund?
Well, there's lots of questions. So first of all, the 1 cent a share, fully franked, is for the half year ending March this year. We originally said we would try and pay it for a dividend for the full year ending September. We now propose to pay half-yearly dividends of at least 1 cent. We've only started paying them because we have put enough reserve, enough of our. We've created what's called a profit reserve, which means that we can be confident that we can pay dividends at the rate of 1 cent a share, fully franked, for at least the next 4 periods.
Yes, you said that, didn't you?
Yeah.
Yes.
So we can't guarantee a dividend. Nobody can do that, but the nature of the business we're doing, we can't. But we can say we can move towards a smoother expectation over the medium term, and that's where we are now, which I'm very happy about, by the way. I mean, that's a lot earlier than we expected to be confident. We initially thought maybe 1 cent a year for the first few years, and maybe paid once a year. Now we're confident we can pay 1 cent a year. 2 cents a year paid every 6 months, which is a bit of an improvement.
And how does that compare with the Global Opportunities Fund?
Okay, it's a different legal entity. Basically, the Morphic Global Opportunity Fund does pay distributions, they're called not dividends, but its distributions are much more volatile, and they're determined by, we have no choice what we pay, it's determined by basically the tax rules. We have to pay out all our realised profits in each period. So sometimes it'll be none, and sometimes it'll be quite a lot. So it's much more volatile.
Well, I think that the reputation of the Global Fund is very good, and generally investors have done very well with it.
Correct.
I'm just trying to...
No, from the point of view of distributions are probably over the long term going to be higher, but they'll be much more volatile. Chad, do you have something else?
I was just going to add on that the ASN, so if we don't have any realisable gains in a half, there'll be no dividends paid.
The distributions. The distributions on the...
Because of different structures. So for a dividend investor, it's really better to stay with an LIC, isn't it?
I think if the manager and his board are doing a good job, I blame it all on the board, of course, but if the manager and the board are doing a good job, we will try and smooth that return series for you. But obviously, if we go through 3 years of very bad performance or very bad markets, then the dividends could dry up. But what we're trying to do is make sure we've got enough put away for a rainy day. Sorry, I'm going to give you another go.
Yeah, you know that saying.
Hit me.
You know that saying, a rising tide lifts all boats.
Yes.
Right. Well, that 11% since you started that you've gained, is that because of you or in spite of you? Because it might have been higher if you'd have just done nothing too fancy.
That's a very hard question. You mean you prefer us to go on holiday? Sometimes
If I'd bought the Misky, I would have done better.
Yes, that's true. But you wouldn't.
Of the cost.
Yes, look, there was. I mean, slightly. I won't disrespect your question, but you know, Warren Buffett is out there at the moment saying ETFs are a much better investment than managed funds. Well, you know, he's probably right in bull markets and right what's called rising markets, but he's 100% wrong in falling markets. Because in a falling market in ETF, what do you get? The market returns. Whereas what you'll be hoping from your fund manager is he'll actually protect you from some of those losses in a falling market. That's a choice you make when you're an active manager or an ETF. And we believe that actually investors are willing to forgive a little bit of the upside in a rising market. They do expect some protection in the falling market from us. Is that?
If the current leader of the federal opposition gets his way and he abolishes imputation credits for Australian dividends, all other things being equal, which would be a better tax structure for dividend-style investors, your listed MEC fund or your unit trust? Because I note that you did say that the unit trust has to distribute all the earnings, whereas the listed companies such as MEC does not. So would that put those people that are invested in your unit trust at a little bit better advantage in terms of a tax structure?
Well, thank God. I wake up most mornings being really glad I'm not an expert on tax. And I'm really not. I really can't answer that question. I do, however, think, I don't think, I mean, I'm not a great fan of Bill Shorten, but I don't think he plans to actually abolish imputation credits. What I think he's threatening to do, although inconsistently, is to take away the cash that people in pension phase in their superannuation accounts can get back for the imputation credits that aren't used. So I don't think it's quite as bad as you're saying. I think the imputation was a reform brought in by Paul Keating as Treasurer. I don't think the Labour Party is about to abandon imputation. It's just about to say, well, they have said, and then retracted it, that they will take away the cash that pensioners get back. So I don't think it's a real live issue at the moment.
Well, they're still going to stop paying the cash on the surplus.
Well,
that means some people lose $10,000 a year of their income because of that.
I thought he'd pulled back from that, but I've got Christopher Zinn here, who probably knows more about this than most of us. Christopher's an old friend of mine from university.
No, I don't. I'm interested in how competitive this area of responsible asset management is. So why are you so much better than other people in the market? How would you say, what is your competitive advantage?
I think there's probably three elements. First of all, there's not many global equity responsible investment firms out there in Australia, and indeed in Europe. I mean, Chad's out there talking to people across Europe for our newest fund, and there are surprisingly few managers out there, almost none. That was interesting. Who offer a risk-managed product in the responsible equity space. So that's fairly rare. Secondly, we do have this I think edge in that we are willing to both go long and short. Now I know some people in this room don't like it, but we regard it as part of an edge and a point of difference, and actually something that is good for our purpose, if you like. It's not a very big field. One of the other large managers out there in this space mainly focus on what's called positive green investing. That is their own thematic investing, where they only invest in companies they think are going to make the world a better place. We think it's a very high risk strategy, and the history of their returns suggests it is, because you get sucked into you have a very narrow range of companies you can invest in, and you end up having very volatile performance. So that's a point of differentiation for us. So I can only say that over the years that Chad and I were at Hunter Hall and subsequently here, we've generally done at least as well as the market, and in our time at Hunter Hall especially, much, much better.
I think one of the reasons that your share price isn't doing very well is that the company is very illiquid. Hopefully, if the options do get up to that most people will take them up, that will help a bit. The alternative is if that doesn't happen, is possibly to have a large rights issue at below NTA value.
Well, my concern about yes, look, I mean, obviously, you've got a terrible conflict. As a manager, you want to have more funds under management, get more fees. But I think as a director of MEC, and again, I've got one of my co-directors here with me. Our view is we don't want to do anything that is dilutive to existing investors. Those are the people we owe our obligations to. And when you have a rights issue, not everybody can take up their rights, and so they get diluted. And the other people who can take up their rights get the benefit of that dilution. So I'm a little bit, cautious about that concept at the moment. In terms of the illiquidity, I've learned over my years of investing, there's two kinds of illiquidity. There's the illiquidity when there's too many sellers and not enough buyers. There's the illiquidity when there's too many buyers and not enough sellers. I'd kind of like to get into that second group, and we're not there yet.
Well, just to finish, I think the majority of the shareholders are pretty sticky, and I don't think many of them are selling, which is...
Yeah, no, that's right. Yeah, I mean, I looked at the market this morning before I came here with Jeff, and we're looking. If somebody was to try and buy 200,000 shares in a hurry, the share price would be above $1.11. To give you an idea, that's how illiquid it is. Sorry,
towards the start, did you mention a new fund or a joint venture or something you're working on?
No, okay, well, Chad, so we have got a new fund, but it's not really focused on Australia at this time.
Yeah, so I'll try to answer two questions there. So we've launched a pure hedge fund selling into European clients. And I've been over in Europe for about 5 weeks this year, and I've presented at a couple of conferences and that. And this is, to Chris's question on what's your point of differentiation, well, it's easy to differentiate when there's no other funds. We are literally the world's first ESG hedge fund. What's your competitors? Well, there's nothing essentially. And to be honest, when we were approached by our partners in Europe, and I was like, you've got to be kidding me. Surely a Scandinavian or a Swedish firm would have thought of this already. Like, this is a world full of fund managers. Everyone thinks of something like this already. And there's this gap between long-only managers who only buy shares and don't short, and they might care about ESG or responsible investing. And then there's hedge funds which see themselves as the swashbuckling pirates on the ocean who will go long tobacco and they don't really care about anyone else's ethics. And there's this gap in the market. So we've been selling that product over there, or we've just launched it. It's got, I think, $8 or $10 million in it at this stage. But there's a massive, the institutional interest over there is huge. Because they want to allocate to hedge funds who do the shorting. There's things that we find debatable here, but they also want to do it in an ESG inclusive way, and there's just really no product out there at the moment.
And so that won't be available to Australian investors just through the structure?
So, yes, it is. At the moment, it's wholesale only. But we are setting up a feeder fund at the moment. We have one large Australian client that's going to put 20 million into it. But we are, so everything's there to consider offering it to retail at some point in the future. But generally, demand for pure hedge funds in Australia has traditionally been quite low. People here prefer equity funds on average. So that's why we hadn't offered it here first. It's the same stocks, it's just run to different risk parameters and different risk appetites.
A little bit more leverage.
Yeah, we've got more leverage in it.
But typically less market exposure as well.
What about institutions here in their current funds? Is there any interest or not?
Look,
or should there be any interest?
Look, I don't think the institutions here are as advanced as they are in Europe, to be honest. I mean, your industry super funds really haven't got a lot of interest in this stuff.
There's the odd one that does that offer ethical.
Yeah.
There's some of them are offering more ethical options. I was just wondering whether that might be an in for the fund.
They wouldn't invest in our fund typically. They would do it themselves. But there are, I mean, there's probably two genuinely independent, ethical investment superannuation products here, Australian Ethical Super and Future Super, but they both have a much narrower base of stocks because they're both, Future Super doesn't invest in any greenhouse gas companies or any company that has any touch point with greenhouse gas even at the level of minutiae. So, for example, they won't invest in any Australian banks because they have, and by the way, Australian banks have almost no exposure to fossil fuels. But they have even $1 of exposure, they're out. So and then they do cut their universe quite a lot.
I was actually going to ask Anne, your thoughts on European interest in ESG versus Australia?
I think Australians aren't far behind. I mean, it's definitely there's just due to the population and but you know we're the fourth largest sort of pool of superannuation funds, so that gives you know us a big a big sort of place at the table. And certainly Australians were some of the early adopters in terms of the PR. The Principles for Responsible Investment was started by an Australian, James Gifford. So I think it's just growing. It's definitely growing in Australia. But the Scandinavian companies, investors have obviously been at the forefront for many years, in which started out with the traditional ethical investing, and now with the ESG integration push, I think Australians are up there. Whether it's the marketing and the greenwash that happens in the investment side as well as the company side, you definitely need to dig a bit deeper in what's going on inside the funds as well.
One of the things we do as part of the check measure to make sure we're not doing anything that would be contrary to what our beliefs is, we actually follow very closely what the Norwegian Sovereign Wealth Fund, which is it's $1 trillion fund run by the Norwegian government, and they don't invest in any fossil fuels. They also, with $1 trillion under management being a government instrumentality, they have a lot of resources to do very deep ESG research. So we actually, we have as a checkpoint, we don't invest in any company they've published as on their banned list because they've got the resources, frankly, to do stuff we don't have to do. So, and they're very thoughtful.
I was just wondering, perhaps you should be marketing to some of the big superannuation funds. If they're not doing it, they're not providing people actually do.
So the question was, should we be marketing to some of the large superannuation funds?
Because they don't have the option, that's it, and people actually would like the option.
Yeah, well, look, can I just say, watch this space. Yeah. We are having talks with somebody who might help us develop a superannuation product. We don't think that the actual funds themselves are going to invest with us because it's just not their mindset. They're not their mindset, I think, to be that engaged with what we do, and not their mindset to support smaller fund managers in Australia, sadly.
I had a very depressing Tuesday last week in Melbourne with some very large, I won't name them, but the two very large industry super funds. And what's sad is for all the investors that they think they're buying ethical options, and you go meet the people who are actually allocating. They're doing it because they've been told to do it, not because they have any interest in it. And it's not. And I'm not saying that because they didn't choose us, or they may not choose us. They're not going to choose anyone. They don't. A lot of them don't really believe in it. And what's interesting is it's being split into a group. They call themselves the Gang of Eight, who are pushing hard to try and get the industry funds to move. And I'll tell you who the leader is. Australian Super's probably actually one of the best. They're doing a good job of integrating. But there's a large group of industry super funds who are either affiliated with the mining or industry, or whatever reasons they've decided that this isn't really an area that they're interested in, which is, I think, a disappointing outcome for their end investors, that they don't want to allocate any money into the space. They're more interested in saying, we don't own coal, or something like that, which is not really ESG investing in my thought.
If you can somehow convince the non-believers, and if everybody starts putting 2% to your account, you'll be sitting with billions of dollars.
No, well, seriously, we're trying with the Japanese, with that Japanese company. Why not try with the industry super funds?
Well, we do talk to them. Yeah. I mean,
I just wondered that because there's a big pot of money sitting there. There's a whole lot of their members who may be interested in having an ethical option. They don't have the wherewithal to actually run one. So, farm find out somewhere.
The super funds have got so many billions, and these guys are too small.
Yeah.
Well, that's you need to get bigger.
Well, so if we convert all those options, that's step one done.
Look, guys, I think, are there any other questions, or shall we break? Oh, sorry, one more, sorry.
Okay. Look, I'm referring to page 15 of the booklet titled Morphic Assets Management.
Yep.
You've got
The presentation
on the Trump dislikers and the Trump likers.
Yep.
I'm just wondering, the green and the orange are approaching each other. Is that the reason? Is that another reason why you support your belief that he will remain? Because you can't have people. They seem to contradict each other, the two colours, if you know what I mean.
It's a very simple. Let me explain what we think. There's a bedrock of people who support Trump. Well, let's face it, they've already proven they'll support Trump through sexual molestation, anything, because it was already known about before the election. So that bedrock of people aren't going to go away. And in some ways, we hope they don't. Because my view is, if Trump is left completely unpopular, he will become more irrational. That's scary. We do think, for what it's worth, or as I think, and I'm not going to necessarily hold my colleagues to this, but I think that the Democrats will have a very good time in the midterm elections, but I think there's a high probability they win back control of both the House and the Senate, which I think will be more of a break, or what the founding fathers call the checks and balances, which I think will be a good thing. But we don't want him to become so unpopular, he does really crazy stuff, if I can say that. That's the investment conclusion we have there.
All right. But in any way, does that chart, the yellow and the green chart, in any way also add additional support? If so, could you explain how it does?
It's basically saying that there isn't much movement. His net popularity goes up and down, but not in a very narrow range.
Okay. And one final question. You mentioned that you feel Telstra is still overvalued. What would you say, from your opinion only, and I regard this as totally discretionary, what would you place its value at?
Well, look, one of the advantages we've got, if you like, looking at Telstra, is we are a global investor. So we've looked at telecommunications industries around the world. And I think Telstra's got a number of challenges. One of it is that it's lost control of its backbone. The NBN, which is what gave it pricing power over its competitors, the old copper network, which gave it pricing power over its competitors, it's lost that. It got paid some super profits for a while, which it paid out in non-sustainable dividends. How it's going to replace it, I'm not sure. It's got a bunch of capex coming up for a so-called 5G, which is the next generation of mobile phones, where it doesn't start with as much of a huge advantage as it had in 4G over its competitors. It's got a bunch of belligerent, yappy, smart, aggressive, opportunistic competitors, and it's a bureaucracy. And I don't wish to cast aspersions on the management of the company, because they have a tough job. But I look at Telstra over the last... I've visited Telstra back to the days when it was Telecom Australia. That's how long I've been looking at it. They've gone through a wave where they've had sort of, you could call it, three kinds of management. You've had the reformist, let's make lots of changes guys, who often ended up being heavily criticised. And you had the guy who inherited all the change, the benefit of all those changes, and had really easy times, got a bit lazy. Then you had the poor sucker who inherited the company at the point where all the easy stuff had been done, all the early benefits from his predecessor, or the predecessor had been achieved, and he's left with a mess, and he typically fails. And you have another guy come in who with a guy who turns it all around as a hero, and maybe he's a hero, or maybe just gets criticised as well. And finally, you have the guy who just cruises on. Now, we're in the guy who's probably going to fail. That's not a good time to be investing in stock.
And just finally, and I know this is
Does that make sense, by the way, to everybody?
Yeah, quite subjective. What would you place its value at, considering all those problems that you've highlighted very well?
Well, I'd just say less, because I think too much of the less, because there's too much of the value at the moment is based on expectations about the dividend having finally bottomed, and I suspect it may go lower. And when it does, there'll probably be another drop down.
Okay, thank you.
Thank you very much.